Hello and welcome to another episode of the Ideal Investor Show. And I have been wondering if you guys have actually recognized that if we think back a few years, there have been so many people who said, well, the interest rates will start coming down in 2024, and here we are almost halfway through 2025, and they still haven't gotten down, right? And I have been posting a couple of episodes here on the show stating that one of the really core things that the media doesn't seem to want to understand is that the relationship for our mortgage interest rates is really to the 10-year treasury. And if the 10-year treasury bond is not coming down, which is, by the way, currently hovering around about 4.5%, it was even briefly almost reaching 5%, then mortgage interest rates are not coming down. The other thing is they just passed something called the Big Beautiful bill in the Congress. I don't know if it's going to make it through the Senate by the time you hear this episode, but the point is that supposedly beautiful bill has a lot more spending, a lot more debt, and we're already at $36 trillion. So that begs the question, okay, who is going to buy these bonds for 4.5%? Now, why am I bringing this up? Because today's episode is the impact basically of these high interest rates on our investing. And what I've always said, regardless of what the interest rate for the mortgage is that you're getting, or for the loan, if you want to call it that you're getting for your investment property, the main point is that you really want to make the numbers work, that you look at the performance at the day of purchase. So what does that really mean translated for our investing or for your investing? Well, it means that one thing that you could look at, especially in an environment with high interest rates as we have it now and have had it for years, and I think if you ask me, it's probably going to be another 2 years until we really get it down to something meaningful, and I think it could take even a little longer, mainly because it's obviously one part the government, and the other part is just the economy and finding people who are willing to pay for these bonds. So there is a chance that the economy is really roaring, and then it might be possible to lower interest rates, but then the risk is that the economy is overheating. So it's a very tricky balancing act. But like what I was saying about the importance of the deal at the day of closing. If you only look or give yourself the principle, which is what ideal wealth grower investors do, to say, I do not buy a property, I do not make a residential real estate investment if I don't at least have some positive cash flow. If that is your own setting, your own rule, then if you can find properties, and obviously I help you with that through our massive network of all kinds of providers that have relationships with us. So we want together find properties that still with these high interest rates provide positive cash flow on day one. And the measures that you can do to get the positive cash flow is, number one, don't overpay for the property. And number two, find a property for a good price in a good neighborhood so you can get really good rent from dependable tenants. Because ultimately, how do you get cash flow positive? You take the cost of your mortgage, which is the principal, interest, insurance, and property tax. How much do you have to pay for that per month? Then you take the 10% or thereabouts property management and a little bit of reserve, anywhere between 10 and 15% of the rent. And then you want to have something left. So quick example, if you find a property that costs $200,000 and it costs you, let's say, $1,200 a month for the property mortgage and another $180 a month for property management, and then a little bit, let's say 10% reserve, you're ending up somewhere in the $1,600 to $1,700 range. So you need to find that property at that price with rent income of $1,700, $1,800, $1,900 or even $2,000 if you can find it. That would mean you have $100, $150, $200 in positive cash flow, maybe even a bit more. Now, why is this relevant in the context of high interest rates? Well, think about it. Normally, we always go for 30-year financing. Now, obviously, we have the option to refinance, but if we look at it right now, and we are already cash flow positive because we really researched our deal. And then let's say in 3 or 4 or 5 years, the interest rates have come down and you can get a mortgage instead of 8% right now, you can get it for, let's say, 5%. So you refinance for 5%. Well, if it was working well and had positive cash flow at 8%, it will only get better at 5%. Right? So that's just something to reconsider. And if it takes 5 years until it comes down, you wouldn't even go for another 30-year mortgage. You would only get a 20 or 25-year mortgage. Right? So that's actually how you look at it and how you should look at it, because then you can say, okay, I find a property that is cash flow positive right now. Going forward, I can only make out better because you are locked in for 30 years. And if the circumstances get better, then you take advantage. If they stay the same, well, then that's just what it is. Now, there's one exception that you could try, and in some rare cases, it is available, and that is what's called owner financing. So if you think about somebody bought a house for their family that was just recently renovated, or in some cases, they bought the house and then renovated it themselves. And when they bought it, let's say in 2020 or 2021 for like a mortgage rate of 3.5% or 4%. So if you can buy the property with the mortgage attached, well, then you have an even better deal, and you would try to keep that mortgage for as long as possible or until you can get a mortgage for a similarly low rate. The tricky part about that is always how it's going to be handled for an investment property. But that's the exception. If you can find a house that has all the performance parameters met, and you can get owner financing right now with owners having like mortgage rates between 3 and 4 and 4.5%, you definitely want to do that. But if that's not available, then just make sure that you have positive cash flow at the day of purchase. Because then in the future, at some point, interest rates will come down again, and then you will basically lock in an even better deal. So that's it for today. I hope you're already a paid subscriber to our Substack newsletter. And if you're not, I really, really want to urge you to do that. And with that being said, be well and stay safe. And I talk to you tomorrow.